If you want to predict how far a stock could potentially go in any given period of time, this video is for you. Technical analysts like to look at past data to predict future movements. However, the options market allows us to see implied volatility and give us what's known as a expected move, or what I call a risk range. These risk ranges give us an extremely good probability to where price may close within a given period of time and how far it could potentially move. You can think of it as a bell curve. 68% of the time, if the stock is trading at, say, $40 and our expected move or risk range is, say, $5, that means it can go up $5, which would be what? 45? Or it can go down $5, which would be 35. This means that there's a 68% probability that it will close within that range. That is some very useful information, especially given a specific period of time. For example, what I like to use for it is the weekly risk ranges. Now, that is what I draw on my weekly briefs every single week, and people have been asking me hundreds of times, Michael, how do you get that data? How do you get those levels? Well, that's what I'm going to show you. So we are in the middle of the trading week, and you can see the SPY tagged this perfectly. What do you think happened next? Well, it actually came right back within slightly, okay? Look at the Qs. It tagged the upper risk range, and it came right back in. The IWM tagged it off of a very strong day, and it came right back in. And we can even look at various sectors like XLY. Came out, came right back in. XLK went out, came right back in. This is a very, very powerful tool that can be used as an extra tool on your tool belt to get a good idea as how far the market could potentially move in a given period of time. Like I said, I like to use it on a weekly basis. Now, this is how I use the product and get those levels. All right, so I'm here on the Thinkorswim platform. If you don't have the Thinkorswim platform, that's totally fine. Now, I like to personally first go to the trade tab, but I do this on the close of business on Fridays, and I go to the following week options expiration. Now, because we're in the middle of the week, I'm gonna go hit the Analyze tab, I'm gonna think back, and now I'm gonna go back to the start of the end of last week, so Friday the 25th, to get a good idea as to where the market might go, like with the charts that I just recently showed you. So Friday the 1st, which is April the 1st. Now, when I'm there at the options chain, I would go to April the 1st because that's a week out. And what Thinkorswim does, it has a proprietary calculation. You can see the implied volatility and the little sign here that says plus or minus. Now, if you don't use Thinkorswim, that is totally fine. A lot of platforms have their own calculations for expected moves, and they do offer them. But if you're on Webull, if you're on, which I does not think that it has it, if you on Robinhood, I don't think it has it, but you can use this method for kind of just a cut and dry, very simple calculation for an expected move. If you go to where the stock is trading right now, now keep in mind, there's something very important here. When you are looking at these expected moves, you need to do it with very liquid names. Okay, so the big dogs like Google, Microsoft, Nvidia, Tesla, the SPY, the Qs, the IWM, etc. Very liquid. The more liquid that it is and the more volume that trades on the options chain, the more data that it has to really have a honed in expected move where we can finish within that one standard deviation. Okay, so I go out to April 1st, which is 7 days out. The expected move is $9. I draw that on my chart. So how do I draw that on my chart? Well, simply put, if the week closes at 452.69 as the last point it traded, I would then just draw a line that is plus $9 out, right? And then I would draw the line like that, and then I would go draw another line out that is minus $9 out because that's the expected move. Now, if I don't have the expected move calculation on my platform, a very simple way to do it is by going to the at the money strike. So it's at 452.69, so we're just going to be 453. And what I do is I would just add the ask of what it's currently basically selling at, the call, and add it to what the put is currently going for too, which is on the ask. So it'd be 384 plus 430. Add that together, it gives us $8.14. So as you can see, that would be our plus or minus. And that is pretty darn spot on here overall, especially given it's a $453 product. So after I get that information, I just go to the chart and I draw the lines out manually. And then what I like to personally do is it gives me an idea that, hey, 68% of the time, it's probably going to close within that expected move. And if it gets outside of it, chances are that it could come back within that range. There's a highly likelihood. So what I personally like to look for is if it gets on the outskirts of this very early in the week. So today's Wednesday, or actually this chart is when it was Tuesday. So immediately after 2 days of trading, right, the week closed here, priced in a $9 expected move, and then within 2 trading days, we already met what the options market priced in. So to me, what does that mean? Well, it means that the possibility for this to go up, there's less likely reward for it to go long right here than there is a risk to the downside. So right there would mean, hey, if you were long on this move, chances are you should be taking a little bit of profits right here. And or if you are looking to short a position, or there's various option strategies, you can short into that. And as you know, if that were the case and you were prepared, the very next trading day, it did go down 0.62%, and it was actually down even further, but it just closed down at 0.62%. Now, we still have 2 more trading days left in the week, but there is still that 68% probability that we will be closing within this range. So keep in mind, there is still risk to the downside here versus reward to the upside. Now, you might think, well, can it get outside? Well, absolutely, but understand that when you look at the terms of a distribution curve and you have one standard deviation move on both sides, they will do whatever they can to defend these levels. So if they get outside of these levels and they have to do what's called as dynamic hedging, it could produce explosive moves out of those specific levels. So you must be very careful if the price action gets at an extended period outside of those risk ranges. I hope that helps out and gives you some insight into how I use these risk ranges and or expected moves.